Thanks for stopping by today. Today we're going to talk about calculating debt-to-income ratios for first-time homebuyers. These ratios are going to determine how much mortgage payment you can actually afford to spend every month. These ratios are somewhat misunderstood by the general public because they're confused a lot of times with your credit utilization rate. Let's take, for example, when you factor in all of your credit lines, that you have $10,000 worth of the credit line and your balance on that $10,000 is $3,000. Well, the credit utilization rate on that would be 30%, but that 30% doesn't have anything whatsoever to do with your debt to income ratio, which is factored against your income and what your minimum monthly payments are. Before we get too deep into this subject, first let's tell you who we are and what we do. My name's Roger Lazzarino, and I'm a licensed mortgage loan officer and managing real estate broker for Mid-Florida Realty. My NMLS lending license number is 1123746. Our mission is to provide Mid-Florida Realty customers with the very best mortgage loan programs that suit their individual financial and credit profile. We're an unusual real estate company because so many of our realtors are either currently licensed mortgage loan officers or were so at one time or another. Many times we can do this by using some type of down payment assistance program, whether it's for first-time home buyers or using creative lending techniques. We specialize in helping Florida first-time home buyers with down payment assistance, as well as non-first-time home buyers achieve home ownership, whether we use down payment assistance programs or just old-fashioned creative lending techniques. We'll do everything that we can possibly do to get you the house that you really want that fits your budget. We work with some of the largest down payment assistance providers in the state of Florida. When we started the company back in 2014, we only had 2 or 3 different down payment assistance programs. Now we have over 20 different DPA programs that help first-time home buyers or people that have already owned a house. The real estate division of Florida Down Payment Assistance is Mid-Florida Realty. And to avoid any potential legal or ethical misunderstandings, we will not originate other realtors' customers' loans, advise any other realtors, loan officers, or their customers in any form of communications. We want to protect Florida first-time home buyers from getting misinformation from third-party realtors or mortgage people that don't deal with these programs on a day-to-day basis. With that being said, now let's talk about the loans. Now, I'm going to slow this down a little bit because this requires understanding a little bit of basic math, and I don't want people to get lost while we're talking about these very important calculations. These calculations will determine how much house you can actually qualify for in underwriting guidelines. There are actually 2 separate guideline lending ratios for all mortgage loans. The housing ratio, also known as the front-end ratio, and the debt-to-income ratio, which is called the back-end ratio. The front-end ratio guidelines for FHA and conventional mortgages are somewhat flexible between 31 and 44%, depending on your credit scores and other compensating factors, such as liquid cash on hand, assets such as stocks, bonds, 401k accounts, gold and silver assets, but cars and boats are generally not considered assets because they aren't considered liquid. The overwhelming majority of mortgages use automated underwriting software, and that calculates the borrower's risk factors such as credit scores, liquid assets, back-end and front-end ratios, and that's why there's no real hard and fast rules regarding maximum allowable front-end ratios. Back-end ratios are a lot more defined and rigid. To calculate your front-end ratio, you add up all your monthly projected housing expenses, like principal, interest, taxes and insurance, any mortgage insurance, and HOA or CDD fees. Then divide that by your gross monthly income. So the example is, if all your housing-related expenses total $1,600 and your gross before tax monthly income is $5,000, then your housing expense or front-end ratio is 32%. And that's really an exceptional front-end ratio. Now, something that could severely skew this front-end ratio, but may not have an effect on the lending decision, would be this. Let's just say you had very little credit card or installment loan or student loan debt. So you wanted a little bit more expensive house because you don't have any other debt. So now let's say that your total housing expenses are about $1,850 a month and you're still making a gross monthly income of $5,000. Well, now your front end ratio is only 37%, which is still a pretty good housing expense or front end ratio. I do want to caution you though, however, if you're trying to get a USDA loan, because USDA loans have their own set of guidelines, and the front end ratio on USDA loans is a lot of times capped at 31%. So you have to be careful. So now we're going to calculate the back end debt to income ratio. And this ratio is the one that everybody focuses on, but as you can see from the previous slide, there's more to consider. Many first-time home buyers cap the debt to income ratio at 44.99%, but others may be capped as low as 40%. Still others, which are in the conventional realm, might be capped as high as 49%. So you don't really know what you're going to qualify for until they actually run it through automated underwriting. But by listening to these YouTube videos, at least you have a clue as to what's going on and what to expect. The back end / debt to income ratio is calculated by adding together all the projected housing expenses from the last slide and all of the borrower's minimum monthly debt payments and dividing the sum by the borrower's monthly gross income. This works a lot like the front end calculation, except on the back end, you're including all of the minimum monthly debt payments. So again, let's take the borrower's gross monthly income at $5,000, and let's say his minimum monthly debt payments as well as his housing expense totals $2,000. Well, that's going to give you a back end ratio or a debt to income ratio of 40%. Which is a pretty low back-end ratio, to be honest with you. On the next slide, I'm going to show you how I actually figure how much you can spend for a monthly mortgage payment. So now we have the moment of truth. How much can I really spend a month and still qualify for a mortgage? In the two preceding screens, we discussed acceptable front and back-end ratios. That's all well and good to illustrate how the lending guidelines actually work. But when I calculate how much you can spend on a house payment, I do it slightly differently. In the case of the back-end DTI ratio, I take your monthly gross income, again before taxes and any deductions, and multiply that by the particular loan amount program's maximum front and back-end debt-to-income ratios. Obviously, I do each one of those calculations separately. So let's just say that the down payment assistance program is capped at 45% maximum debt-to-income ratio. I'm going to take your gross monthly income and multiply that times 45%, and that's going to give us the maximum amount of money that you can actually spend and still qualify for this particular loan program. I do the exact same thing with your housing ratio, and of course those figures are different depending on the front end guideline ratios for that particular loan program. For the front end ratio, I might use 31% if it's a USDA loan, or if that particular loan program front end ratio is capped at 31%. Again, you kind of have to know how these programs are capped to actually determine if the borrower / buyer is going to qualify for that particular loan program. And of course, both ratios must be satisfied for the loan to be approved for that particular program. Now, for a different program, you might have a totally different set of ratios. As I've said before, mortgage lending is a lot like crossing a lake that's 1 foot deep that's the size of Lake Michigan. None of these guidelines is too complex. It's just there's so many of them. For example, on the FHA Lending Guideline Handbook, it's 1,139 pages. And if you want to see what it looks like, just click the link below and you'll get a good idea of what your loan officer is going through. And this is just one particular set of guidelines. You still have conventional guidelines, and those are broken up between Fannie Mae and Freddie Mac. And then you've got USDA guidelines, then you've got VA guidelines, and then you've got all of the down payment assistance overlays. So that should illustrate to you to start your process out with a realtor that has some idea about how guidelines work in the lending process. That it's very important for you to get somebody that actually has a clue as to what's going on with down payment assistance, because there's a lot of variables in all these programs. And the other weird thing about lending is what's true today may not be true tomorrow. So my advice is to get a realtor and a lender team that know exactly how down payment assistance works. because in the world of down payment assistance, two experienced heads are much better than one. Remember, you've got money on the line, and the worst thing that can possibly happen is, at the end, a guideline pops up that the loan officer was not aware of, and you're past your inspection deadline, your appraisal deadline, and your financing deadline, which means you may just have lost $2,500 or more per the real estate contract. Believe me, I'm not trying to scare you, but what I do want to do is make sure that you realize that these are actual contracts, and you need to be represented by people that understand them and also understand lending guidelines. Thank you for attending one of our YouTube seminars. All of our seminars are on our websites below. Please subscribe to our channel and you'll see and hear about a lot of different programs. All of us at Mid-Florida Realty feel that by educating our buyers/borrowers, you'll have a much smoother and a much more successful home buying process. If you have any questions about this or any other first-time home buyer or down payment assistance program, and you haven't made a commitment to a realtor, please call our office and we'll get you in touch with one of our local Mid-Florida agents who really are down payment assistance experts. Now, if you want to hear a little bit about our disclosures, you can wait for the next slide. Thanks again for attending, and hopefully we'll be speaking with you soon. Please understand that all mortgage loan products change from time to time or can even be canceled without notice by the sponsors. We're not always told about changes in the loan products that we discuss in our broadcasts. However, we present the current facts at the time these videos are developed. We suggest that you obtain current loan information directly from one of our loan officers or agents to determine if a loan product in its future current form aligns with your needs. Thank you again for attending one of our seminars. Take care and good luck.